Welcome to Module 5, where we'll focus on adjustable and floating rate mortgage loans. In this section, I'll explain how variable rate home financing works, including the areas where costs can change over time. We'll also look at the key factors borrowers need to consider before deciding if this type of mortgage is right for them. Understanding these points is crucial because adjustable rates can impact your monthly payments and long-term affordability. Let's dive into the details so you can make informed decisions when it comes to financing your home. An adjustable rate mortgage, or ARM, is a type of home loan where the interest rate is fixed for an initial period, but after that, it changes over time. These changes are tied to a market index, plus a margin set by the lender. This means your monthly payment can go up or down depending on how the interest rate adjusts. The key idea to remember here is that the rate is not permanent. It's adjustable, which is why it's called an adjustable rate mortgage. This allows for potentially lower initial payments, but also comes with some uncertainty in the long term. Let's take a closer look at the differences between ARM, or adjustable rate mortgages, and fixed rate mortgages. Starting with ARMs, these loans have interest rates that change after an initial fixed period. Typically, the starting rate is lower compared to a fixed rate mortgage, which can make them appealing at the outset. However, because the rate can go up or down over time, your payments can vary, so they're often best suited for borrowers who plan to own the home for a shorter period or expect to refinance before rates adjust significantly. On the other hand, fixed-rate mortgages maintain the same interest rate throughout the entire loan term. This usually means a higher initial rate compared to ARMs, but the benefit lies in predictability and stability. Your principal and interest payments will remain consistent, which is particularly attractive for borrowers who value steady monthly expenses and plan to stay in their home long term. In summary, ARMs offer lower upfront costs but come with less payment certainty, while fixed-rate mortgages provide greater payment stability with a higher initial cost. Understanding these differences will help you decide which mortgage type fits your financial goals and plans for homeownership. This slide focuses on the initial rate period of adjustable and floating rate mortgage loans. During this initial period, the interest rate is fixed, which means it doesn't change and provides predictable payment amount. This fixed rate only lasts for a set number of years. After that, the loan switches or resets to an adjustable rate, which can vary based on market conditions. Understanding this fixed initial rate period is important because it sets the groundwork for how the loan payments will change over time once that period ends. This concept is a key part of Module 5, where we dive deeper into adjustable and floating rate mortgage loans. Let's talk about how the interest rate on an adjustable rate mortgage, or ARM, actually changes over time. At each reset date, the lender starts by looking at the current index rate, which is a benchmark interest rate that fluctuates with the market. Then, your loan's fixed margin is added to this index rate. This margin is the additional percentage the lender charges you on top of the index. Together, the index plus the margin determine your new interest rate. But before that rate is finalized, it's important to consider any caps that might apply. These caps limit how much your interest rate can increase or decrease, both periodically at each reset and over the entire life of the loan. Finally, once the new rate is set within these limits, your monthly payment is recalculated based on the updated interest rate and the remaining term of your loan. So, even though the calculation is straightforward, each step plays a crucial role in determining what you'll actually pay going forward. Let's talk about the common indexes used in adjustable rate mortgages, or ARMs. These indexes serve as the benchmarks that your mortgage interest rate will follow. The first one is SOFR, which stands for Secured Overnight Financing Rate. It's based on overnight Treasury-backed lending and has become a widely used standard in modern ARMs because it reflects real market activity. Next, we have the Treasury Index, which uses yields from U.S. Treasury securities, typically those with one-year maturities. This index is popular for rate resets and gives borrowers a sense of stability tied to government debt. Then there's COFI, or the Cost of Funds Index. This index is connected to what savings institutions pay to acquire funds, and it usually adjusts more slowly, meaning changes in your mortgage rate based on COFI might be less volatile. Finally, we have the prime rate, a bank reference rate linked to short-term credit conditions. It's less common than the others, but still appears in some ARM products. Understanding these indexes is important because they directly impact how your interest rate changes over time. Knowing which index your arm is tied can help you anticipate rate movements and plan accordingly. Let's break down the key components of an adjustable rate mortgage, or ARM. First, we have the margin. This is a lender's fixed markup, and importantly, it stays the same no matter what happens to the index. The interest rate on an ARM is calculated by adding this margin to the current index rate. For example, if the margin is 2.25%, that's added on top of the index rate to determine your overall rate. Next, we have caps, which play a crucial role in protecting borrowers. Caps limit how much your interest rate can increase, preventing sudden, large spikes. There are two main types: periodic caps and lifetime caps. A periodic cap limits how much the rate can change at any single adjustment period. For example, no more than a 2% increase at each reset. The lifetime cap, on the other hand, limits the total amount the rate can increase over the entire life of the loan, such as never more than 5% above the original starting rate. So, to sum up, the margin sets the fixed markup that the lender adds to the index, while caps set the ceiling to keep your rate from getting too high too quickly. Understanding both will help you manage the risks associated with an ARM. Here, we're looking at the common structures of adjustable rate mortgages, or ARMs. The key idea is that these loans start with a fixed interest rate for an initial period, after which the rate adjusts periodically. For example, a 5-to-1 ARM means the rate is fixed for the first 5 years, then it adjusts once every year. Similarly, a 7-to-1 ARM has a longer initial fixed period of 7 years before annual adjustments begin. On the other hand, a 3-to-1 ARM has a shorter fixed period of 3 years before those yearly adjustments kick in. The initial fixed rate period provides stability, while the annual adjustments allow the rate to respond to market changes over time. Understanding these timelines is crucial when choosing the right ARM structure for your financial plans. Here, we're looking at the payment structure during the initial period of an adjustable rate mortgage, or ARM. The key thing to understand is that the introductory interest rate helps keep your early monthly payments lower. Even though your payment might seem smaller, it still covers all the core components: principal, interest, taxes, and insurance. So, the savings aren't because you're skipping any housing costs. They come solely from that lower introductory interest rate. For example, during this fixed rate introductory period, if your interest rate is 4.25%, your monthly payment could be around $2,000. This breaks down into roughly $420 for principal, $1,060 for interest, and about $520 for taxes and insurance. This structure allows borrowers to manage lower initial payments while still paying down their mortgage and housing expenses comprehensively. It's important to see this example as a snapshot of how the early payments work before the rate adjusts later on. Here we're looking at the concept of payment shock that occurs with rate adjustment on adjustable and floating rate mortgages. For example, imagine your monthly payment jumps from $1,500 to $2,100. That's a 40% increase. This kind of sudden rise isn't just a theoretical risk. It's very real. When the introductory period of a loan ends, borrowers often face a new payment level that might not fit within their existing budgets. After the reset, higher interest rates translate into a more significant household cash flow problem, making it harder to manage everyday expenses. Understanding this payment shock is crucial when considering adjustable rate loans. Now let's look at an example of how a 5-to-1 adjustable rate mortgage, or ARM, adjusts its interest rate. During the first 5 years, the borrower enjoys an initial fixed rate, which in this example is 4.25%. This is the introductory rate for that fixed period. At the end of year 5, your loan rate is recalculated based on the current index plus a margin. Here, the index has moved to 3.1% at the time of the first adjustment. The margin, which is a fixed amount added to the index, remains constant throughout the life of the loan, and for this loan is 2.25%. To determine the new adjusted interest rate, we add the current index, 3.1%, to the margin, 2.25%, resulting in a fully indexed rate of 5.35%. This is the rate before any caps or limits on adjustments come into play. This means the rate has increased by 1.1% from the initial rate. Understanding this calculation is important because it shows how your monthly payments could change after the fixed rate period ends, depending on how the index moves. Now, Let's talk about some important risks and considerations when dealing with adjustable and floating rate mortgage loans. First, payment uncertainty is a key factor. Because the rates can change over time, it can be difficult to predict exactly what your future monthly payments will be. This uncertainty can make budgeting a challenge. Next, interest rate volatility plays a big role. Borrowing costs tend to move in line with broader market interest rates. So if rates rise, your mortgage payments are likely to increase as well. Another critical point is payment shock. When an adjustable rate resets, your monthly payment can jump significantly, which can be a financial shock if you're not prepared for it. Lastly, refinancing risk is something to keep in mind. Even if you want to lower your costs later by refinancing, it might not be easy or even possible, depending on market conditions or your financial situation. Understanding these risks is essential in making an informed decision about adjustable or floating rate mortgages. When deciding between an adjustable rate mortgage or ARM and a fixed rate mortgage, the key is to consider your timeline and how you expect interest rates to move. An ARM can make sense if you plan to sell or refinance before the initial fixed period ends. This way, you can take advantage of lower starting payments to improve your cash flow in the near term. Also, if you believe that interest rates will stay flat or even decline in the future, an ARM could be beneficial. On the other hand, a fixed rate mortgage is usually the better choice if you intend to keep your home for a long time. Fixed loans provide payment certainty, which is important if you want predictable monthly expenses and can handle the risk of rising rates. Essentially, fixed rate loans trade off some flexibility for stability and peace of mind. So, the best decision really depends on your individual financial situation and how you expect your housing timeline and interest rates to evolve. Understanding these factors will help you choose the mortgage that fits your needs the best. Let's talk about rate caps and why they're so important when it comes to adjustable rate mortgages, or ARMs. Rate caps act as your protection against volatility by putting limits on how much your interest rate can increase. Think of them as built-in guardrails. They don't prevent the rate from going up, but they do limit how much damage those increases can cause. There are two main types of caps to understand. First, the periodic cap. This cap limits how much your interest rate can change at any single adjustment period. For example, say your current rate is 5%. Even if the market suggests a jump to 8%, with a periodic cap of 2%, your new rate would only rise to 7%. Then there's a lifetime cap, which puts a ceiling on how high your interest rate can ever go during the entire life of the loan. So even if the market rate skyrockets to 12%, if your lifetime cap is 5% above your starting rate of 5%, the maximum you'd pay would be 10%. These caps are crucial because they provide stability and predictability in managing your mortgage payments, especially in a volatile interest rate environment. They ensure that your monthly payments won't suddenly become unmanageable, giving you peace of mind throughout the life of your loan. Let's dive into the concept of floating rate mortgages. Unlike typical adjustable rate mortgages, where the interest rate adjusts only on preset dates, floating rate mortgages have an interest rate that moves continuously with the benchmark rate. This means that whenever the market reference rate changes, the loan's interest rate can rise or fall immediately. Because of this, floating rate mortgages are much more responsive to current market conditions. In contrast, standard ARMs wait for specific reset dates before adjusting, which can cause a lag in reflecting market changes. Understanding this difference is crucial as it affects how your mortgage payments might fluctuate over time. Let's talk about how market conditions influence the popularity of adjustable rate mortgages, or ARMs. First, ARMs tend to gain more market share when fixed mortgage rates jump significantly. Higher fixed rates make the lower initial payments of ARMs more attractive to borrowers, giving them a more affordable entry point. Next, when borrowers anticipate that rates will fall in the future, ARMs become appealing since these loans offer the chance to benefit from rate resets or refinancing later. This expectation of a declining rate environment encourages borrowers to choose ARMs, hoping to reduce their costs down the line. Additionally, in uncertain or volatile markets, demand often shifts toward ARMs with more features like caps, greater flexibility, and shorter holding periods. Borrowers want the ability to adapt to changing conditions without being locked into a long-term fixed rate. It's important to remember that the adoption of ARMs follows a cyclical pattern rather than a constant trend. Their popularity rises and falls depending on how the economic and interest rate environment evolves, reflecting how borrowers weigh the trade offs between fixed and adjustable options. When dealing with adjustable rate mortgages, managing the ARM risk is crucial, and one important strategy is timing your exit before the higher payments kick in. The ideal moment to refinance is usually before the very first adjustment occurs, while you're still benefiting from that initial teaser rate, which makes your payments more affordable. It's also important to be aware of any prepayment penalties that might apply. Some ARMs charge fee for early payoff, so you should carefully review whether such a penalty exists, how long it lasts, and whether refinancing or selling your home could trigger this fee. There are several common strategies to consider. Refinancing early can be a smart move if market rates drop or if your credit profile improves, helping you secure better terms. Another approach is making extra payments toward your principal before the reset date to reduce your balance and potentially lower future payments. And finally, if you value payment stability, comparing fixed rate conversion options could be the way to go. Remember, understanding this key refinancing window is essential to managing your ARM effectively and keeping your payments manageable over time. When calculating your potential future payment on an adjustable rate mortgage, the first step is to estimate the adjusted interest rate. It's important to use the highest likely rate, not just the introductory low rate, often called the teaser rate, so you get a realistic picture of your future payments and can ensure the loan fits within your budget. Start by identifying the current index that your loan is tied to. This index fluctuates and serves as the baseline rate for your loan adjustments. Next, add the margin, which is a fixed percentage added to the index to determine your fully indexed rate. This means your adjusted rate equals the index plus the margin. Then, apply the caps, which limit how much your interest rate can increase with each adjustment or over the life of the loan. You'll want to use whichever is lower, the fully indexed rate or the capped rate, because this determines your maximum payment amount. In simple terms, you take the minimum of the sum of the index and margin or the cap limit. For example, if the current index is 4.2% and your margin is 2.5%, the fully indexed rate would be 6.7%. However, if your first adjustment cap limit's rate increases to 2%, your adjusted rate will be capped at 6%. This method helps you estimate your future payments more accurately and avoid surprises. On this slide, we're focusing on the regulatory oversight and restrictions surrounding adjustable rate mortgages or ARMs. The key idea here is that these rules are designed to make the risks of ARMs transparent before a borrower commits to the loan. First, lenders must follow the ability to repay standards set by Dodd-Frank. This means they have to evaluate whether the borrower can actually afford the loan payments, not just the initial lower teaser rate. They need to consider payment shock, how much the payments could increase when the rate adjusts. Next, the Consumer Financial Protection Bureau requires lenders to provide clear disclosures. Borrowers must be informed about the index and margin used to calculate the rate, how often the rate adjusts, any caps on rate changes, and the worst-case payment scenarios they might face. There are also limits on riskier ARM features. Loans with potentially sharp payment increases have stricter underwriting and disclosure rules to protect borrowers. Overall, the main goal of these regulations is borrower protection. They ensure that borrowers give informed consent, fully understanding how their interest rates reset and how high their payments could rise over time. This transparency helps borrowers make better financial decisions when considering adjustable rate mortgages. On this slide, we're looking at specialized types of adjustable rate mortgages, or ARMs, specifically negative amortization and interest-only ARMs. These loan options can help lower your payments in the early stages, making them more affordable up front. However, there's a trade-off to be aware of with negative amortization. Your payments are actually less than the interest that's due. The difference doesn't just disappear. Instead, it gets added to your loan balance. This means your loan amount can actually increase over time, which is a risk because the balance grows before it starts to go down. Then there's the interest-only ARM. During a set interest-only period, your payments only cover the interest, not the principal. This keeps your payments low at first, but once the interest-only period ends, your payments can jump significantly as you start paying down the principal. While both of these options provide short-term affordability, they come with higher long-term risks. These include increased overall costs, potential loss of equity in your home, and the possibility of payment shock when payments rise sharply. It's important to weigh these factors carefully when considering these types of mortgages. Hybrid ARMs are the most common type of adjustable rate mortgage structure. They start with a fixed interest rate for a certain number of years, providing stability at the beginning, and then switch to a variable rate that adjusts on a set schedule. The naming convention is straightforward. The first number indicates how many years the rate stays fixed, and the second number represents how often the rate resets after that period. For example, a 5-to-1 ARM means the rate is fixed for the first 5 years, and then it adjusts annually. This option is popular among borrowers who expect to move or refinance relatively soon, as it offers a short fixed period initially. The 7-to-1 ARM has a fixed rate for 7 years before it starts adjusting every year, giving more payment stability before entering the variable phase. Finally, the 10-to-1 ARM fixes a rate for a full decade before annual adjustments begin, making it the longest commonly used hybrid ARM. Buyers often choose this when they want lower initial rates but want to avoid reset risk in the near term. Overall, hybrid ARMs offer a balance. They provide the security of fixed payments up front, followed by adjustable payments later on aligned with market rates. This setup suits borrowers whose plans fit the timing of these fixed and adjustable phases. Let's look at some real-world borrower scenarios to understand how adjustable rate mortgages, or ARMs, can fit very differently depending on the borrower's situation. First, consider the first-time buyer. This person is purchasing a starter condo and expects to move within 5 years. The lower initial payments of the ARM make it easier to qualify for the loan and helps preserve cash flow in the short term. For this borrower, the ARM is a good fit because their ownership timeline is shorter than the period before rates adjust. Next, we have the investor. This borrower plans to renovate the property, increase rents, and then refinance or sell it. They use the initial fixed rate period to keep carrying costs low while improving the property. The key here is having a clear exit strategy plan before the rate changes. Finally, the relocating professional expects an employer transfer before the first rate adjustment. This gives them flexibility and income stability to manage the loan without risk. However, if the relocation gets delayed and rates rise, the risk goes up significantly. The takeaway is that ARMs are most effective when the borrower's expected timeline is shorter than the ARM's reset period. It's not just about the low initial rate. Understanding the context is critical to determining if an ARM is a strategic choice or a risky one. Let's take a closer look at the key metrics involved in adjustable and floating rate mortgage loans: the index, the margin, and the rate. First, the rate is calculated by adding the index and the margin together. The index is a market benchmark like SOFR, which currently stands at 4.2%. This index moves up or down based on broader interest rate changes in the market. Next, the margin is a fixed number set by the lender, in this case, 2.5%. This margin stays the same throughout the life of the loan and is essentially the lender's markup added on top of the index. When you combine the index at 4.2% and the margin at 2.5%, you get the borrower's new interest rate after each scheduled adjustment, which here totals 6.7%. This adjusted rate reflects the current market environment plus the lender's fixed margin. Understanding how these pieces fit together is crucial for grasping how adjustable rate mortgages change over time. Here are some important red flags to watch out for when considering an adjustable rate mortgage, or ARM. First, if you have a tight monthly budget, even small increases in your payment can create real strain on your cash flow. It's important to have some flexibility to absorb those changes. Second, if your income growth is limited, future rate increases could outpace what you're earning, making payments harder to manage. Third, if you plan to own your home long term, the risk of rising rates becomes more significant because you'll be exposed to those adjustments over a longer period. Fourth, if you have a low tolerance for uncertainty and prefer predictable expenses, fixed-rate loans tend to offer better peace of mind. Finally, many borrowers assume they can refinance before rates rise too much, but refinancing isn't guaranteed. Factors like lower credit scores, declining home values, or higher overall market rates can block that option, so it's risky to rely on refinancing as an exit strategy. Keeping these red flags in mind can help you decide whether an ARM is really the right choice for your financial situation. Looking ahead, the future of ARM markets is shaping up to be more tailored and transparent, focusing heavily on borrower flexibility rather than just rate speculation. We'll see smarter product designs that respond more directly to the needs of borrowers, with adjustable loans becoming easier to understand through hybrid terms, clearer caps, and simpler disclosures. Rates will continue to drive demand, especially when fixed rates remain high, making ARMs an attractive option for those seeking short-term affordability. Digital monitoring tools like apps, alerts, and refinance analytics will play a crucial role in helping borrowers manage reset risk before payment shocks occur. At the same time, emerging alternatives may compete primarily on flexibility, but the fundamental question across all products will remain: how much future rate risk can the borrower realistically absorb? Ultimately, technology combined with rate volatility will be the key forces shaping the next generation of mortgage options. When evaluating variable rate borrowing, there are four key ideas to keep in mind. First, rates can change. This means that both adjustable rate mortgages or ARMs and floating rate payments may rise after the initial fixed period or fluctuate as market indexes move. Second, the structure of the loan really drives the cost. Factors like the index it's tied to, the margin added by the lender, the timing of rate resets, and any caps on increases all play a role in determining future interest rates. Third, while these loans often offer lower rates at the start, that initial savings comes with uncertainty later on. The main risk for borrowers is what's called payment shock, a sudden jump in your monthly payment when the rate adjusts. Finally, it's important to remember that whether an ARM is the right fit depends on your personal situation. They work best when your timeline is clear, your income is stable, and refinancing options are realistic. Keeping these 4 points in mind will help you make a more informed decision about variable rate mortgages. Let's walk through a decision framework for whether an adjustable rate mortgage or ARM might be the right choice for you. First, consider if you expect to move or refinance before the first rate reset. If your ownership horizon is short, this can significantly reduce your risk of facing higher payments later. Next, ask yourself if your budget can handle higher payments down the line. It's important to stress test your finances against potential increases, not just rely on the initial lower teaser rate. Third, weigh whether the savings you get today are worth the uncertainty of future rate changes. Look at the total cost of the loan under different interest rate scenarios to get a clear picture. Finally, make sure you fully understand key loan terms, specifically the index, margin, and caps, so you know exactly how and when your payments might change. If you can answer yes to most of these questions, an ARM could be a good fit. If not, it might be better to prioritize payment certainty with a fixed rate loan.